Welcome to the Empowered Investor Podcast, brought to you by the advisory team at Toulette, Matthews and Associates. Have you ever felt overwhelmed by the number of voices telling you how to plan or invest for your future? We're here to help you cut through the noise, bringing clarity to your investment decisions and helping you build lasting financial peace of mind. Learn more and subscribe today at tma-invest.com. Welcome to the Empowered Investor. My name is Keith Matthews, and today I'm joined by our co-host, Andrea LeRoyer. Andrea, welcome to today's show.
Thank you, Keith. I'm really happy to be here.
We're talking about income tax today, how to prepare for your income tax returns, what to do, how to work with professionals. Andrea, tell us a little bit about your background and what you do at our firm.
Sure, Keith. So I've been here for about a year and a half now. This is our second tax season. Right now, we're working in a team of 5 to work with clients during tax season. We have Edmund as our supervisor, and we're really in the full swing of things right now here at TMA during tax season. A little bit about my background. I had my own tax preparation business previous to joining the team here at TMA. And I've been super excited about learning about growing my knowledge and contributing to the team.
You did a podcast last year with me, actually, for our clients and for our listeners. It was an unbelievable episode. I recall you provided a framework. How does a person think about going through the tax season? That podcast that you did last year provided a lot of people with clarity. We got really good feedback from listeners, and I'm excited about today's show. In today's show, we're going to discuss the key dates that everybody needs to know about. We're going to review any changes that have come through with tax laws relative to last year. We're going to discuss how do you organize yourself? What are the things, what kinds of slips you should be looking for that get mailed to you, and what kinds of information you need to go get. And then finally, you're going to offer lots of really great tips for our listeners on specific types of situations. So we have a busy show today. Let's jump right in. Andrea, let's talk about key dates now.
Okay, so for key dates, we have a bit of an easier time this year than we did last year. Last year had a little bit of a complicated, messy beginning. There was some uncertainty regarding the increase in the inclusion rate for the capital gains exemption, and so we had some extensions in the filing deadlines. And we also had delays with Canada Post. So none of that this year. It's back to business as usual. And the first date I will mention is the tax filing deadline for 2026 is Thursday, April 30th.
Perfect. So that's right back to the way it used to be. Nice and easy, April 30th.
Exactly. April 30th. No weekends get in the way of that. So it really is that.
Midnight. Midnight, April 30th.
Midnight, April 30th.
Great.
For self-employed individuals, it's June 15th. Although, just a little reminder that if you do have taxes owing, you do have to pay that by April 30th. So you can file later, but not pay later.
Okay, perfect.
So the deadline to contribute to our RSPs has passed. It was March 2nd. It's always within the first 60 days. So that's something to keep in mind for next tax season. Just make sure you get your contributions in on time. And individuals were able to start filing as of late February. February 23rd was when those first online filings could happen. So now we're mid-March and, everything is underway.
Perfect. I mean, it's a lot smoother of a start versus last year. Last year, I remember even the tax systems had not been updated. There were delays because there were delays of rules and regulations on capital gains.
That's right. Yeah. So tax systems, the tax filing software was not ready to go. People were getting their slips later than normal. So it took a while longer to get everything together in order to be able to file.
Okay. So when are most slips ready? And slips, I guess we're really talking about income slips, whether you work and get a T4, whether you get pension income. When are those slips typically ready? And when are the investment slips typically ready?
Most slips are ready by the end of February. So by the beginning of March, most people have all those slips in their hands. There are some exceptions. For instance, trust slips, they can sometimes come at the end of March, even beginning of April, because those trust returns are only due by the end of March.
And so typically that some investments come in the form of trust slips. So sometimes you can't finish or even complete your tax return until those are in.
Exactly.
Okay,
That's right.
great. Okay, so let's jump in. Those are the most important things about the dates for this year.
Those are the key dates. That's right. Yeah.
Perfect. Let's now move into the area on key changes. We've listed about 4 or 5 major changes relative to last year's tax return. So let's start with what you've jotted down here is there's been a change in the income tax rate for the first tax bracket.
That's right. So the federal tax rate was reduced to 14%. It had initially been 15%. This was effective just as of July of last year. So actually, the average rate for last year will be 14.5, and income earned in 2026 will be the first full year that we get to take advantage of that 14% tax rate.
So federal tax rates come down from 15 to 14, and that first bucket is on what amount of money?
It's on amounts, income, about $57,000 or less.
And less. Okay. What are the implications for credits inside of this zone?
Yeah, so that's a good question, because even though we have those rates for the tax brackets coming down, on the flip side, most non-refundable tax credits are actually calculated using the lowest tax bracket rate, which is now 14%. So that decrease in the tax rate for this first tax bracket would actually make those credits slightly less valuable. So the good news is that the government has introduced a top-up credit, which will maintain the value of some of those credits that will be effective until 2030.
Okay, perfect. So we're going to list a few other things here. We've got the Canada Groceries. Here's some changes, new introductions. Canada Groceries and Essential Benefit. What exactly is that, Andrea?
Right. So that's essentially an enhancement of the GST, so the goods and service tax credit. So it builds upon this credit that individuals were previously eligible for. So there's 2 enhancements. The first is a top-up payment. So individuals who are eligible for this credit will receive an amount this year. It will be paid before June of this year. And there's also the benefit will be increased by about 25% over the next 5 years.
Okay. And so that's a benefit that usually low-income individuals will receive that benefit. Students receive that benefit.
That's right.
Perfect. Next major change is being the list of disability support. The types of things that are now deductible has been expanded.
That's right. So the disability supports deduction is essentially a deduction for individuals who need special help or equipment in order to work or go to school. And so in order to be eligible for this, you do have to be eligible for the disability tax credit. And then there are some devices that you will be able to deduct, such as ergonomic work chairs, bed positioning devices that you previously weren't able to take advantage of before.
Perfect. Okay, let's keep the conversation going with the changes. Here's another one. There's a new benefit called the Canada Disability Benefit. Who is that? It's a brand new benefit, correct?
That's a brand new benefit. It started summer of last year, but during our podcast last year, we didn't have a chance to talk about it. So it's a benefit for individuals who are aged 18 to 64 and qualify for the disability tax credit. It's up to $200 a month, which is actually a pretty significant benefit. And the total amount is based on the family net income.
And that's a brand new benefit that was introduced.
That is, yeah.
Okay, perfect. One of the interesting changes we're now going to talk about is the fact that individuals that have short-term rentals, like short-term Airbnb rentals, if they're not compliant, can no longer get any expense deduction on that property. That's a pretty big one because in cottage country all over Canada, individuals have been buying small properties, and then sometimes the municipalities don't allow for Airbnb, but prior to this law, they were getting away with deductions.
That's right. So now, if you own a short-term rental and you're earning rental income, but you're not in compliance either with municipal or provincial laws, you aren't actually able to claim any of the expenses that go into owning and running a rental company.
Yeah, that's a pretty significant addition if you're a property owner.
That's right. So you really want to make sure that you have your licensing, your permit requirements, that everything is up to date so that you can claim those expenses.
Okay, great. Fantastic. I'm going to keep on going along here. A new change is digital news subscriptions has ended.
That's right. So you used to be able to claim a small non-refundable credit if you had a subscription to digital subscriptions, such as the Globe and Mail, Financial Post. However, that has now ended.
So that's gone. And the last one, which has been scrapped, has been the underused housing tax.
Yeah. So
what's that all about, Andrea?
That's no longer in effect. It had been a 1% tax that was charged on certain vacant homes in Canada if they were owned by non-residents. So that went on for a period of a few years, but now it's been scrapped.
So this law was initially put in to discourage individuals from buying property and leaving them vacant.
That's
they
right.
would tax them on that.
That's right.
That tax is now being removed.
Yes.
Okay.
Correct.
So I know we've just jumped in a bunch of details here, and listeners, thank you for your patience, but these have been sort of the big changes from last year, correct, Andrea?
That's correct. Yeah, there weren't any huge changes, so this really summarizes everything that was important and noteworthy.
Well, the big one, I guess, that really hit the newspapers was the reduction of income tax on the first tax bracket.
That's right.
That hit the front page, and that was sort of the big news. Okay, so let's go to the next sort of section of today's podcast, which is let's try to give some advice as to how individuals should put together their information. It's a little bit repetitive from last year, but it's fantastic and needs to be reviewed. You've got it broken down into two main sections. What information comes to you, and what information do you need to go get? So let's talk about the information that individuals will receive by Canada Post.
Yeah, so either by Canada Post, and these days a lot of, these slips are coming electronically.
Yep.
So it could go into online portals, it could be emailed to you. So these are what will make their way to you in one of those methods. So slips that you will receive are either T4s, Releve 1s, pension income, investment slips, interest and dividend income slips, security information.
Okay. So all the information with regards to your revenue
That's right.
usually comes to you.
That's right.
Okay, what else?
So you also need your notice of assessment, and if you live in Quebec, you also need your Quebec notice of assessment, so you'll be looking at having two. Those normally make their way to you either by mail or in your online portal.
And that usually comes the previous year.
That normally comes the previous year.
So you usually finish your income tax, and then a few months later you get your notice of assessments. You need to keep those notice of assessments, and you need to hand them in. You need to either use them if you're doing your own income tax,
Yeah.
or you have to hand them in to your tax preparer. Exactly. And what does a tax preparer find on that notice of assessment that's important?
So there's a lot of interesting information that's pretty relevant on these notice of assessments. You'll find your RRSP contribution room. If you have an FHSA, you'll find your contribution room for that account as well. If you've taken advantage of the homebuyer plan, you'll have the information regarding what payments have to be made to pay back into your RRSP for that. You also have capital loss and tuition credit carry forward amounts, as well as alternative minimum tax carry forward amounts.
Okay, so it's a pretty important document that lists basically your standing. All these different types of account trackers are listed on the notice of assessment.
That's right.
Okay. What's the last major set of documents that you might receive?
Something really important that you generally receive at the beginning of the year would be your installment payment summary. So that's for individuals who generally have a larger tax owing. Throughout the year, they're asked to make installment payments. And this is a summary that you would receive in the mail or in your online account, summarizing everything that you've paid already to the CRA, and if you're in Quebec, Revenue Quebec.
So that's a pretty important summary.
Yeah.
What are the types of individuals that would have installment summaries, and what are the types of individuals that don't have installment summaries?
Generally, if you have high investment income, you would have an installment summary. If you have high investment income, you would have a larger tax owing, and therefore you would be asked to make installment payments, and therefore you would receive an installment summary. If you're self-employed, that's another reason that you might also be asked to make installment payments.
Yeah, so typically it's if you are always having your taxes deducted at source, there's typically no need for installment payments unless you have a significant portfolio that generates income and additional interest, at which point they want their money.
Exactly.
The government wants these installment payments because they don't want to wait a year to get their money.
They don't want to wait a whole year. That's right.
So these documents are critical and need to be collected to prepare your income tax.
Yes.
Okay, so this is great. This has been the section on what you can receive either by mail or by portals. All your income, your notice of assessments you have to keep, and all your summaries of installments. All right, so look, we've captured, in essence, the really big parts about what information will come to you or what will come to you automatically. Let's go to the next section, which is what slips do you have to go chase?
Sure.
And I remember this. This goes back personally. I remember Hugh, who did my tax returns 20 years ago. He'd always say, Keith, you got to go get all this information. And I was always like, Hugh, can you remind me what I have to go get? And I mean, I know what comes to me, but so this is what you got to go get. It's what you got to go run after.
This is what you got to go get. And so I guess this podcast would have been helpful to you, Keith, 20 years ago or so. So we have the childcare expenses. So these are receipts, or if you're in Quebec, there's the Relevé 24 for any childcare related expenses. So this includes daycares, camps, if you have a nanny or a babysitter, as well as if your child is part of, the lunch program at school or the after-school program.
Okay.
If you're a parent and your child is in certain sports or art activities, such as hockey, rugby, music lessons, painting classes.
Andrea, I love the fact that you added rugby in there.
That one's for you, Keith.
Thank you.
There is the Children's Activities Refundable Tax Credit in Quebec that you can claim, and so you need those receipts so that we can enter that into the software.
Okay, what's next? What else do you have to go get?
So for students who are in post-secondary education, they need to go into their student portals and they need to get their tuition slips.
Okay.
So this is the T2202A, and in Quebec, the Relevé 8. So these are really important. They are the only amounts we can claim in terms of post-secondary education. Oftentimes, I'll get receipts from, Staples, Bureau en Gros, for materials that parents think they can use to deduct the expenses of school supplies. Unfortunately, we can't use that. It's really just those two slips.
Okay, perfect.
The next thing is our RSP contribution slips. So this can come in many ways. Sometimes you will receive that in the mail. Sometimes you would have to go into your online banking. Sometimes you can even get it in person at the bank when you're making a contribution. So it really varies, but we just wanted to put it in this section so that you're mindful. If you haven't received it, make sure to go and get that. That, of course, is a very important deduction.
Okay, what's next?
Medical expenses. So throughout the year, if you have prescriptions, if you've been to the optometrist, the dentist, these are all important expenses that you want to be able to put into your tax return. So we're going to need those receipts. If you have private insurance, we also ask that you bring in those summaries from the insurance companies just to make sure that we're only claiming the amounts that haven't been covered by the insurance companies.
Okay.
There's also donation receipts. So if you make a donation to a registered charity, there is a credit associated with that. Unfortunately, those GoFundMe donation receipts, they aren't registered, so we can't claim those. You don't have to worry about getting those together.
Okay, and we've got one final section, but it's an important section.
Yeah, so this is home office expenses. So this is for people who have an office in their home. There are some expenses that they're able to claim.
So can you walk us through kind of general calculations? And offline, just before we recorded today, you said there's 3 categories. Let's start with the 3 categories.
Sure. So there's 3 different worker categories, and depending on which one you fall into, it means that you can claim expenses for different things. So there's the employee, so somebody who works for a company, but they have an office at their house. That is one of the categories. The other one is employee earning commission. That is the second one. And then there's also for the self-employed individual who has an office at their home.
Okay, and I guess with each category, you get certain abilities to deduct.
Exactly.
Some a little bit more than others.
Exactly.
And so how does the calculation work? I'm going to give you an example. I have, just to use numbers rough, a 200 square foot office in a 2,000 square foot home.
Right. So
Tell
that
us
would
about
be,
the calculation.
that would be about 10% of your home area.
So I get to deduct 10% depending on different variations of whether I am an employee, commission-based, or self-employed.
Yeah, exactly. So it would be about 10% of whatever expenses you're able to claim. So this can be things like hydro, home internet, rent, property taxes, mortgage interest payments. So these are all possible depending on which type of worker you are.
Perfect. So this whole section of going out and tracking down your receipts really can be boiled down into a few. If you have kids, you need to go get some slips. You need to go get expenses.
Right.
Young adults who are in school, in universities, you're going to have access to some credit. If you have medical expenses of any age, you have access to some deductions or credits. If you make donations, you have access. And then finally, if you operate any kind of home office, you've got some chasing and you've got some paperwork to fill out.
Absolutely.
Okay, great, fantastic. This was a great way to summarize this whole section. Let's switch gears.
Okay.
And we're going to go into special situations now. You've got a really nice list. You've broken it down into 4 or 5 categories. We're going to try to give some high-level stuff, but you're going to kind of share with us the top things to think about in these different categories. So let's start with category number 1. You're a student, university student. You've maybe started to work. You might be working part-time during the summer. You might have a part-time job during your school year. But what should you be thinking about as a student?
So as a student, you're probably quite focused on your studies. You might just be working part-time. Your income might not be very high. You might think it's not worthwhile to file an income tax return. However, there are real advantages in doing so. So you really do want to go and get those slips that we mentioned before in your student portal, the T2202, the Rule of A8. The reason for this is because those credits that you can get, those tuition credits, can be transferred to a parent who might be supporting you throughout your studies, or you can even carry them forward for yourself. You know, when you start earning a higher income, you can use them then. So that's one reason that it's important to still go get those slips, still make that tax return. Another reason is that there are some benefits that you might be able to get throughout the year, especially as a student, a low-income earner. There are benefits such as the GST, HST credit, the Solidarity Tax credit. So these are all credits and benefits that you would be eligible for if you file your tax return. However, if you don't, those payments don't come to you.
Fair enough. So, and I would assume also if you don't file your income tax, the government doesn't know you've earned revenue. And if you do that for a bunch of years in a row, you're probably foregoing an opportunity to make an RSP contribution when you start working it, when you start having an income.
That's right. So if you are earning even a very small income, it is worthwhile to file those tax returns so that you can start your RRSP contribution room.
Perfect. Okay, great. So that's for students. Now let's talk about the next category, new homeowners. What are the main things that you want to address and bring up here for a brand new homeowner?
So for a brand new homeowner, there are actually 2 really great credits that are worthwhile to mention. The first is a federal credit. It's the homebuyers amount. This is a $10,000 credit, and that's equal to about $1,500. So that's quite valuable. And that's something that you can claim in the tax year where you've purchased your first home.
So that's only for first-time home buyers.
That's right.
It's interesting, that amount. It kind of adds up to what you would pay your notary or your legal closing costs.
That's right.
On your home.
It's super helpful.
So this only goes to first-time buyers. Fantastic. Is there anything in Quebec?
On the Quebec side, there's the Quebec Home Buyers Tax Credit. That's also quite valuable. It's worth up to about $1,400. There are rules with these credits. If there are multiple owners of a new house, you have to split that credit. So if you're a couple, you've purchased your first condo, you've purchased your first home, that credit can be split between the 2 of you.
Perfect. Bottom line, if you buy a home, first time, make sure you apply for these credits.
Absolutely.
Okay, that's fantastic. Next section, families with young kids. And let's say families with, or let's say a couple that has their first child. How does that change things?
So we get a lot of questions from young couples who have just had their first baby. They ask, how does their tax return change now that we've had our baby? And really, it's quite simple. We just add your child as a dependent in your tax return. So we need information like their full name, their birth date, their SIN number if you have it already. And in so adding them as a dependent, we're able to claim things like their childcare expenses, their medical expenses, and you also are eligible for the Canada Child Benefit and the Quebec Family Allowance.
Perfect. Fantastic. Make sure you note this down if you are having your first child.
If you're a new parent, you definitely want to let your tax preparer know, and they will make the necessary updates so that you can take advantage of all the benefits.
Okay, great. So let's go to the next section. Single parents. Is there anything important that a single parent needs to know?
There's actually a wonderful credit for single parents. It's called the Eligible Dependent Credit. Now, this is similar to the spousal credit, but it's for people without a spouse. So it's quite a large credit, and it can reduce your taxes owing by over $2,000.
Okay, perfect. Probably the biggest category now is seniors. We see this a lot with either clients, our existing clients that are existing seniors, or clients whose parents are seniors. And so let's kind of walk through this very carefully because there's some really important things to do here. So let's start with just the category in general. What is available? What should seniors be conscious of?
Sure. So right away, as a senior, if you're 65 years old or older, you might be eligible for the age amount credit. So this is a federal and Quebec credit, and it depends on your income level. But if you are in the lower income bracket, then you might be eligible for this credit.
Okay, that's credit number one. What's next?
So there's an interesting one. This is a tax credit for home support services. This is a refundable tax credit. It's for residents of Quebec. And basically, if you're 70 years old or older and you need to pay for services to help you stay more comfortably in your home, think housekeeping, meal preparation, snow removal, nursing services. This is a credit that is quite generous at 37% of eligible expenses.
So what does that mean? You take all your expenses and you get to deduct 37%?
It's a refundable credit. So you put in your expenses and you're able to claim 37%, and you get money back even if you don't have taxes owing, as it is refundable.
Okay.
So you really want to hold on to those receipts, and that's something important to keep in your tax file so that you have everything ready by tax time.
Perfect. What else if you're a senior?
So there's something called the Home Accessibility Tax Credit. So this is a federal tax credit that helps seniors over 65 pay for renovations and equipment that make their homes safer and easier to live in. So it's a credit where you can claim up to $20,000 in expenses, and it helps with things like mobility stair lifts, wheelchair ramps, walk-in tubs and showers, things like this.
So basically, if you're doing any kind of renovation which will assist you to have a more comfortable life, in this case, if you're 65 and over, you keep the receipts.
That's right.
And you get a deduction.
Let your accountant...
You get a credit.
You get a credit.
Okay.
You get a credit, so let your accountant know you want to keep your receipts and invoices. You also want to keep proof of purchase and installation, if that's something that you've had done.
So that's not just equipment. That's
the actual work
the
behind
individuals
it.
that are actually installing. If
That's
there's an
right.
installation fee, you need to keep that receipt.
You want to keep that.
And I believe Quebec has something called an independent living tax credit, which is a similar concept, but it's for 70 years and over.
Exactly. So it's a similar credit. It's for 70 years and older. It's mainly for equipment, not so much home renovations. So the home accessibility tax credit that we just mentioned, the federal one, if you have to do renovations to your home, this expense can be claimed as the credit. On the Quebec side, it's really just the equipment that we're looking at. However, on the Quebec side, it's a refundable tax credit. So that's a really interesting one as well.
So, I mean, it strikes me that across the country, there's some support mechanisms in place for seniors to help facilitate some extra expenses of them living in their home, also of them renting, which means if they're going into a senior's home and paying rent, they may have some ability to have some credits on that front.
That's right.
There's an interesting one on municipal taxes.
Yes.
That I believe is only available in Quebec.
That is only available in Quebec. It's the Quebec Grant for seniors, and that's to help offset municipal tax increases. So seniors who have been in their home for several years, normally over about 15 years, if they're over 65 and they've been seeing, their property value creep upwards over the past several years, this, of course, is an extra expense when it comes to their municipal tax bill. When they receive it, their tax bill will be higher if the value has been going up. So this is to help offset that increase in expense.
It's an interesting concept. I was talking with a friend at the gym this morning who's in real estate, and he was talking about municipal taxes and how they follow the evaluation of a property.
Right.
And you can see how property valuations have increased across the country dramatically. This is a way of sort of helping a senior stay in their home and still be able to get a little bit of extra support to pay their property tax.
Absolutely. Oftentimes, seniors can be on fixed incomes and they see those values of their houses going up, which is wonderful, but at the same time, there's the stress of the extra expense.
Okay, great. So this is probably one of the biggest categories, which is why we spent a bit more time on, which is the extra things to think about if you're a senior.
Right.
So Andrea, let's finish the senior section with a kind of a subcategory. And let's go into seniors in a senior residence or seniors in a long-term care residence.
Okay.
What are the things that they should be conscious of?
So seniors living in a residence, whether it's an independent residence or more of a long-term care residence, they also have valuable credits that they could investigate claiming. So to help you know exactly what we can claim, I'd recommend providing your lease or a letter of tax to your accountant that you can get from these residences. And that will give us details as to what could be possibly a medical expense or what could be used for the Quebec tax credit for home support services.
Because if I'm not mistaken, each one of these residences, some provide assistance, medical assistance, some don't.
Right.
So the ones that don't, there's a more limited amount of potential deductions. The ones that actually provide medical care, they will carve that out and it'll come in a report back to the individual, at which point they can use that report as additional deduction, additional credits in their tax return.
It's a very valuable credit, and it really depends on how dependent of a senior you are as well, especially for the Quebec tax credit for home support services. If you're a dependent senior and you need assistance with daily needs and personal care, this amount can be much more valuable as well.
It could be huge. I mean, I recall a client story about 15 years ago when a client was staying in a long-term care facility with a lot of medical assistance, and that deduction had not been used for 5 years. Our team found it. Edmund did a phenomenal job of understanding that the client had access to that deduction. We then filed and went back in time 5 years. And if I recall, I think the amount was something to the extent of a tax return of $30,000 or $40,000.
Oh my goodness!
Now that's 5 years worth
of,
and it was significant care. But it just goes to show you how important that deduction is, and then checking out that scenario.
Yeah, you definitely want to let your accountant know if you are in a residence or if your parent is in a residence.
Fantastic. So the last section that we want to talk about with these special situations is income splitting.
Yeah, so income splitting can be very beneficial for seniors. So for seniors who receive eligible pension income, you can allocate up to 50% to your spouse or your common law partner on your tax returns. And this can really pull income out of a high tax bracket and put it into a lower one. So keeping more money in the pockets of the couple.
I remember when this came in, I don't know the exact date, but I remember seeing income tax returns pre-splitting and post-splitting.
Yeah.
And the pre-splitting zone was a world where people spoke about making sure you do spousal RSP contributions because you don't want one person to have a higher pension than the other. All this was kind of changed when these new income splitting rules came in because it made it irrelevant. It was like irrelevant as to where the income's coming from.
Right.
But that splitting decreased couples' total taxes payable
by a huge amount.
Significantly.
Yeah.
By allowing pensions to be split.
Absolutely.
So pensions can be split, RIFs can be split, annuities can be split, a defined benefit pension can be split. Can an OAS be split?
The old age security cannot be split, but there is still an advantage when it comes to OAS, and that is if due to a split of the other pension income puts you into a lower income bracket, you are possibly avoiding the clawback, the dreaded clawback. So that's a recovery tax that some individuals have to pay if their income is too high and they're receiving OAS.
Yeah, so the splitting, another advantage, not only to reducing total income tax payable, is you reduce the possibility of a clawback.
That's right.
Okay. How about Canada Pension Plan or Quebec Pension Plan? Is that a splittable revenue?
So it can be shared, but it's not split in the same way that this other pension income is split. So this actually has to be done by making a request with Service Canada or Retraite Quebec, and it can be done at the source.
So in other words, it's not split at income tax time. It's not split in the tax preparation and the calculation time. It needs to be thought of first and then needs to be split doing paperwork.
Exactly. So
Perfect.
It's not going to be during tax season. It really requires the advanced planning.
Andrea, thank you so much. We're about to wrap up. It's been it's very in-depth. We do a lot of podcasts on the Empowered Investor, but this one is a unique one because it's first of all, we're about a month away from finishing the income tax time. Hopefully this will come up 5 weeks prior to April 30th. It's an important time for all Canadians. Sometimes it's a daunting time. It's a task they don't love to do.
A lot of people think of it as a chore, an annual chore that they can't wait to get over with.
It is one of when we poll our clients, our existing clients, and we do income tax preparation, we do portfolio management, we do financial planning, retirement planning, estate planning, income tax. They often note the income tax service is their favorite service. We just take care of it. We have an incredible team. But it is a sore spot for a lot of Canadians, but you got to get through it.
You got to get through it, and we're here to help.
Yeah. So listen, give us your ending comments. What guidance you have for our listeners on tax?
So remember, good tax planning doesn't just happen at tax time. It happens all year long. So stay informed, understand what credits and deductions you're eligible for, and stay organized throughout the year. Talk to a professional to help get the most out of your tax return.
Listen, that's fantastic advice. To me, that the number one message you say is stay on top of your affairs all year long.
It really helps come tax time.
Perfect. Andrea, thank you so much for being on today's show. This has been a fantastic topic. A lot of detail, a lot of good detail. I learned something new every time. You had a phenomenal way last year of framing things. You still got it. A phenomenal way of organizing your thoughts around tax. So thank you so much.
Thanks, Keith. It's really been a pleasure, and I look forward to next year.
Thank you so much for tuning in, and we'll see you next time. Thanks for listening to the Empowered Investor Podcast, brought to you by Matthews and Associates. If you've enjoyed today's episode, be sure to follow or subscribe, and share it with somebody who wants to invest with clarity and confidence. To learn more about how we help investors build lasting financial peace of mind, visit us at tma-invest.com. Until next time, stay informed, stay empowered, and stay on track to your financial goals. Investment and investing strategies should be evaluated based on your own objectives. Listeners of this podcast should use their best judgment and consult a financial expert prior to making any investment decisions based on the information found in this podcast.